All right, let's jump right in. Welcome to this rigorous explainer where we are putting Evolv technologies under the microscope of the world's greatest investing frameworks. We're going to conduct a complete stock analysis using the philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, before capping it all off with a discounted cash flow valuation.
To see if this high-growth AI security stock is actually worth the hype, here's our game plan. We'll start with a company snapshot, then look through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, followed by DCF and alternate valuations, and wrap it all up with a final investment synthesis. Let's get to work.
Part 1. Company Snapshot.
So, what exactly does Evolv do? They are pioneering AI-based contactless security scanners. Think of those clunky old metal detectors at schools, stadiums, or hospitals. Evolv wants to replace them. The big selling point here is speed. They're boasting up to 10 times the throughput because, well, you don't even have to empty your pockets as you walk through. It's a pretty huge upgrade for venues.
Looking at the raw numbers right now, the market is pricing this company, ticker symbol EVLV, at roughly $6 a share. That gives them a market cap of just over $1 billion. And that is stacked against roughly $160 million in trailing 12-month revenue. Keep those numbers in mind.
Moving on to Part 2. The Buffett Lens.
So, if Warren Buffett were looking at Evolv, how would it grade out? We know he loves a strong economic moat, and Evolv actually has one. Their proprietary RF sensors and algorithms are seriously next level compared to the old alternatives, and they've already snagged massive customers like Disney and the Olympics. Debt is totally manageable too, with a debt-to-equity ratio of just 0.35. But here's where we hit a massive brick wall. Consistent earnings? Not even close. They're posting a negative $36.46 million trailing net income. And return on equity? Another huge fail, sitting at a painful negative 30.16%.
You see, Buffett ultimately cares about owner earnings, basically free cash flow. And since Evolv's current trailing 12-month free cash flow is negative $4.35 million, Buffett's required margin of safety means his buy price today is, well, literally $0. He wouldn't touch this stock with a 10-foot pole until they prove they can consistently generate positive cash flow.
All right, let's switch gears. Part 3. The Lynch Lens.
If Peter Lynch were looking at this, his very first question would be, what category does this business fall into? Well, with an absolutely massive 45% year-over-year revenue growth in Q1 of 2026 and an annual recurring revenue of $127.3 million, Lynch would zero in on this as a classic fast grower. They are expanding rapidly into a gigantic total addressable market. Now, normally, Lynch checks the PEG ratio here to weigh price and earnings against growth, but since Evolv has negative earnings, that metric goes right out the window.
But here's where the plot thickens for Lynch. On one hand, Evolv is sitting on a solid $61 million in cash, which is great. On the other hand, Lynch absolutely loves hidden gems, companies with high insider buying where the big Wall Street institutions haven't caught on yet. Evolv is the exact opposite. They already have 67% institutional ownership. And to make matters worse, a company director recently dumped nearly $700,000 worth of shares. Wall Street is already totally crowded into this trade. So for Lynch, this is likely a hold or just a monitor. It's a fantastic growth story, sure, but it's not a secret, and the insiders certainly aren't loading up.
Next up, Part 4. The Graham Lens.
Now let's run this stock through Benjamin Graham's ultra-strict, numbers-only defensive checklist. Adequate size? Yep. Pass, it's over $1 billion. Strong financial condition? Pass again. The current ratio is a healthy 1.21. But then, the wheels completely fall off. Earning stability? Fail. They're operating at a net loss. Dividend record? Fail. There are none. Moderate price-to-book ratio under 1.5? That is a massive fail. Evolv's price-to-book is sitting all the way up at a sky-high 8.80.
And honestly, this perfectly illustrates the clash between high-growth tech and old-school deep value. Because if you actually try to calculate Graham's famous intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share, the math literally breaks. You just can't take the square root of Evolv's negative 21-cent earnings per share. Graham wouldn't just avoid this stock, his calculator would flat out reject it.
Moving right along to Part 5, DCF and alternate valuations.
So, since those traditional value frameworks really struggle to evaluate a company that's intentionally burning cash to grow fast, we need to bring in our modern quantitative desk to build a discounted cash flow, or DCF model. To do this, we forecast future cash flows, calculate the terminal value, and then discount it all back to today using the stock's weighted average cost of capital. For Evolv, that WACC sits at a pretty high 13.64%, which directly reflects the stock's elevated risk and a high beta of 1.77.
Now here is where we have to make some pretty massive assumptions. Because their current free cash flow is negative $4.35 million, we essentially have to assume that Evolv will successfully transition their business model over time. For the math to work, we're assuming they scale up to a highly profitable 25% free cash flow margin by year 10, keep growing revenue at over 20% annually, and hit a solid 3% terminal growth rate.
But when you run a sensitivity table on those assumptions, basically tweaking the WACC and terminal growth rate to see different outcomes, it shows that any fair value target you get is incredibly speculative. Evolv could theoretically be worth its current price, or even more, but that entire valuation hinges on management flawlessly executing their transition to a pure subscription model and actually reaching profitability over the next decade. No pressure, right?
And when we look at alternate valuation models, they completely confirm this huge growth premium. The market is happily paying 6.7 times trailing sales, nearly 6 times forward sales, and almost 9 times book value. Think about that. For a company with an operating margin of negative 16%, investors are eagerly paying up for this aggressive growth narrative. They are pricing in future success instead of looking at the current balance sheet realities.
Which brings us to part 6, Final Investment Synthesis.
Bringing it all home, if you look at our summary table, the verdict is actually amazingly consistent across all these old-school methodologies. Buffett, he demands we wait for positive cash flow. Lynch, he sees a fantastic growth story, but way too much institutional crowding, which screams hold. Graham, he outright avoids it. And meanwhile, our DCF and multiple models show that the current $5.98 share price already bakes in a highly speculative premium.
So here is the crucial takeaway. Evolv is your classic clash of hype versus reality. The strengths, they are undeniable. We're talking 45% top-line growth, a massive total addressable market, and a clearly superior product that venues desperately want. But the risks are equally glaring. Consistent cash burn, a deeply negative 30% return on equity, sky-high valuation multiples, and, oh yeah, some recent accounting irregularities that actually delayed their SEC filings. Synthesizing all of this, Evolv at roughly $6 a share is a high-potential momentum play, but one that requires immense risk tolerance. It leaves us with this final thought to chew on for your own portfolio. When you're evaluating a genuinely disruptive technology that's completely changing how we stay safe in public spaces, are you willing to pay a premium today for the safety of tomorrow? Or will you side with the legendary value gurus and demand that the hard fundamentals catch up first? Take a good, hard look at your risk appetite and definitely keep a close eye on Evolv's next earnings report.